Over my 17 years of investment experience, I've lived through several market crashes. Back in 2009, I worked for UBS on Wall Street when the stock market fell 50%. In this video, I will share 7 tactics which have allowed me and my clients to successfully invest hundreds of millions of euros without losing any sleep when stocks crashed. The first tactic is actually one of the most powerful ways to deal with any negative emotion, and I learned it from former hostage negotiator Chris Voss. Chris talks about how when you have a really difficult negotiation, for example, somebody has taken hostages and you have to calm them down, one of the first things that you want to do is label the other side's emotions. Okay, so you might say, it sounds like this situation is making you upset, or it seems like you are worried about this deal. And when you do this, it actually diffuses the emotion. It really reduces the intensity of what the other side is feeling. Well, as it happens, this also works on yourself. For example, when the market drops, I will take a break and I will tell myself, okay, Tom, the market is dropping, so you're feeling stressed out about it, or you're worried about your portfolio. And once I acknowledge it, it becomes much easier to move past this first reaction. So the first tactic is labeling. Now, the second tactic is to control what you can control about the situation. Because when we take action, we feel empowered, we feel in charge, and it really lowers the stress level. Whenever there's some disturbance in the market, I always send a message to my training students, and I tell them, here are a few things that you can do. First, you make sure that you've got a safety cushion sitting in the bank that is not invested. Okay, so this is money sitting in a high-yield savings account, which you can use for everyday spending or for emergencies that might arise. Second, you can make sure that your portfolio is diversified. You're not investing too much in one stock or one industry or one region. And third, check that the risk level in your portfolio is appropriate for your age and your goals. Now, certainly, ideally, you want to do these steps before difficult times arise, but going through these items will give you more of a sense of control. So the second tactic is control what you can. Now, the third tactic is going to save you a lot of frustration when your investments don't go the way that you would like. And I think the easiest way to understand it is to study martial arts. So I've had a chance to wrestle some Brazilian Jiu-Jitsu black belts in my day. And I'm not a black belt or any kind of rank in Jiu-Jitsu. So it's always kind of funny because I'm struggling there and huffing and puffing and working so hard and getting nowhere, while the black belt is just relaxing and going with it and making some little adjustments, not even sweating. I waste a lot of energy because I'm trying to resist something that I can't resist or control anyway. And I think something similar happens with investing. Early in my investment career, so back in 2009 when the stock market was crashing, it was the financial crisis, I would spend so much energy worrying about the market. I would read the news and try to predict what might happen next. And I would hope the market would go up and then it would crash and I would be devastated. And it was so much wasted effort because obviously all my thinking and worrying did nothing to influence the market. Today, when I notice the market going down, for example, when Trump announced tariffs on countries all around the world, well, I simply said, the market is going down. This is the third tactic. Accept what you can't control. You cannot force the market to go up. No matter how much you worry about it, it's not going to change a thing. So you might as well not expend that energy, not expend that effort. In terms of practical steps, what this means is first, automating your investments so that you don't have to make a decision about whether to invest every month. Research shows that so-called market timing doesn't work, so this is wasted effort. And second, don't check your portfolio every day, don't do it every week, perhaps don't even look at it every month. Checking your account once a quarter can be more than enough. Doing so more often doesn't help you get better results, it only generates stress. All right, so the fourth tactic actually comes from CBT, Cognitive Behavioral Therapy. This is an incredibly useful skill to develop for dealing with all of life's disappointments. Every time that the market drops, you can view it as a big problem where you are losing your money. But you can also reframe it. You can find other ways to think about it. So here are just 4 ways to reframe market drops. First, it's an opportunity to buy at a cheaper price. When stocks go down, you can invest more and get stocks at a discount. Second, every time that you sell when stocks crash, you lock in losses. So panicking means losing. Third, every market drop is actually your opportunity to become a champion investor, because over the long term, the investors who do the best are the ones who stay calm and stick to their strategy. So this is your opportunity to really demonstrate who you really are. And fourth, every market disruption is actually a really useful life experience. The more crashes, the more challenges you've gone through, the better you become at investing. Plus, it makes a great story. All right, so this fourth tactic is reframing. Now for the fifth tactic. When you have a phobia, like a fear of heights, there's something called exposure therapy that can help. With exposure therapy, you accustom yourself to going to places which are higher and higher and higher up, so you get used to it. And then when in real life you want to go to Barcelona and take a nice cable car ride, you will not freeze up. I really recommend the Montjuic cable car, by the way. It's amazing. When it comes to investing, we are often so afraid of losing money that we don't even think about it. But you should do the opposite. Visualize the worst case scenario. So I actually like to sit there and imagine, what if the market falls by 50%? What if my brokerage account is down hundreds of thousands of euros and my family's wealth falls by 1/2? What will that feel like? What am I going to do? Now, some people in that case will say, well, actually, I have my safety cushion. I can still pay for food and for rent. I'm a long-term investor. All that really changed is a number on the screen. So that really lowers the stress level. Now, other people might say, oh my gosh, I would really not want to be in that situation. That would be horrible. That is also useful because that tells you that today you should be taking less risk in your portfolio. Instead of putting everything into stocks, you probably need to allocate a significant part of your portfolio to safer, lower risk assets. So the fifth tactic is imagine the worst case scenario and decide what you would do. Okay, now the sixth tactic is remember Bogle's folly. All right, so Jack Bogle was the innovator of index funds. In the mid-70s, he created the first index fund available to regular investors. And at the time, his competitors laughed at him. They said, look, with an index fund, you're investing in the whole market, you're not picking the best stocks, and you can't time the market. You cannot avoid market crashes. You just have to keep buying even as the market goes up and down. And they called it foolish. I mean, folly is something that's silly. But over the following years, Bogle's original index fund not only became one of the biggest investment funds in the whole world, it actually outperformed the vast majority of those competitors who laughed at him. It turned out that if you simply invest in the market and keep investing and don't worry about the market ups and downs, you get much better results than the typical investor. And in a way, I lived a version of this story myself. Back in 2016, we started a new investment company in Latvia called Indexo. We were the first to bring index investing to our country. And our competitors, established Scandinavian investment houses like Swedbank and SEB and others, they laughed at us. They said, look, these guys, they can't react to what's happening in the market. They can't help their clients avoid crises. I mean, these index funds that they're going to use, they're just dangerous. They're not appropriate for most investors. I remember being a bit intimidated, a bit afraid. What if these guys are right? But now, looking back 9 years, we can see that the first fund that we ever launched is still the best performer in the whole country. And this is despite the COVID crash, this is despite the high inflation that we had in the meantime, and these Trump tariffs and everything else. So whenever I hear people say that we should time the market and avoid market crashes and do all these smart moves, then I just remember Bogle's folly and I remember our experience. And this reassures me that steady, regular investing without worrying about the market is almost always the best approach. Okay, and now for the seventh tactic, plus one bonus tactic that I've got up my sleeve. The seventh tactic is practice gratitude. And at first, it might seem like this has nothing to do with investing, but to me, this has been really, really helpful. Every morning as I walk to work, I reflect on the good things in my life. I talk out loud to myself, which can look a bit weird, but it really works. I say things like, I'm grateful for my family, I'm grateful for the sunny morning, I'm grateful to have good health, I'm grateful to have the financial situation where I can afford to take risk in the market. And it's a simple principle, but experiencing this gratitude every day helps me stay much happier and much less worried about what's happening in the market. Because even if the market goes down and there are some losses, I still have the most important things in life. I've got my family, I've got health, and I can deal with the market fluctuations more easily. So the seventh tactic is practice gratitude. And now there's a bonus tactic. I'm not a financial advisor. I can't tell you what you should do with your portfolio, but I do run a really cool newsletter for European investors. Every week, I share insights on personal finance, money, investing, and current events. One of my main jobs is to help my readers stay calm even as the markets go up and down. So if you'd like to join over 70,000 readers in 34 European countries, just follow the link in the description.